Thank you. Welcome to the Jones Seminar. It's a pleasure to have Aaron Brown here speak to us on a topic that is not the traditional engineering seminar, and we're going to hear something fun and exciting, I think. He's the Managing Director and Head of Financial Market Research at AQR Capital Management. Aaron received his bachelor's in Applied Mathematics from Harvard University, received an MBA from the University of Chicago. After that, he was an executive director in risk methodology at Morgan Stanley. He then became AQR's chief risk officer, conducting independent oversight and monitoring of the risks assumed by portfolio managers. In 2012, he was the Global Association of Risk Professionals Manager of the Year. He's authored a book, Financial Risk Management for Dummies, marketed by Wiley in 2015. He also co-wrote A World of Chance by Cambridge University Press. He's authored Red-Blooded Risk by Wiley 2012 and The Poker Face of Wall Street in 2006, which was selected by Businessweek as among the 10 best books of 2006. He's focused on developing research and educational resources to address the complex issues facing investors today. And so it's really a pleasure to have him come and speak on his seminar, which was called A Gambler's Approach to Gambling the Globe. But I also see a different title up here. So thank you for coming.
Thank you very much. Thank you, everyone. It's good to be here. We're going to talk about something that was inspired by a Jones lecture almost exactly 4 years ago by Professor Mark Borsuk, who I understand has left for the warmer climes of North Carolina. But this particular seminar, I won't quite say it went viral. It's a quantitative seminar. We can't get too viral, but it's got quite a lot of interest on the internet. I happened to run across it. It was recommended to me. I watched it. And it's a really interesting application of decision theory to climate change. And not climate change really, policy responses to climate change. And I looked at it and it fit very naturally. It was a very good jumping off point for my own work. But we're actually going to talk about something here much bigger than the globe. The real topic, the larger point I want to make, is really the responsibility of quantitative professionals towards social policy. How should you think about using your expertise and actually applying it so it does some good in the world? There's lots of answers to that question. It's a huge area. You could teach entire courses, probably entire degree programs on the subject. I actually believe there's a quantitative answer. It's not the full answer, but a quantitative answer that's very important to how you can actually make a positive as opposed to a negative contribution. Scientists have not always made positive contributions to the world. A lot of the greatest horrors of the 20th century were either inspired or supported by scientists. But scientists do have the ability, and particularly quantitatively trained ones, because frankly most people aren't very good at math, and most people don't like math very much. And a little bit of math expertise put the right way can do wonders for improved policies. And by the way, somebody here might know more about this than I, well, I guarantee people they know more about this than I do. I believe this is a picture of Charles C. Jones. I assumed from the Charles C. Jones seminar that he would be some huge donor of the university or he would be some famous engineer. Apparently he was a successful engineering graduate of Thayer who decided that this was what he wanted to do with his money. I could find no clear pictures of him on the internet, but this is an engineer by the name of Charles C. Jones. He is approximately the right age. He is identified as an engineer working in Hawaii. So my guess is that that is Charles Jones. If anybody knows that there's a better picture of him, please let me know. But for the purposes of today, unless somebody speaks up, we will call thank you, Charles Jones, for the seminar series. Okay. Decision theory is a field that I assume most of you are somewhat acquainted with, although I will give a brief overview of it in this talk. And it is the way quantitative professionals for, frankly, most of the 20th century, since World War II, there's a real applied mathematics revolution in World War II and the years afterwards. And one of the things that came out of it was decision theory. And it's become kind of the axiomatic way quantitative people look at decisions. And in finance in particular, we have a subfield of decision theory we call portfolio management. That is somewhat simplified. It's a specialized version of decision theory. And I was among the people who around 1980 or so brought that to Wall Street. Wall Street in 1980 was not only non-mathematical, it was anti-mathematical. If you had a degree in mathematics, you left it off your resume. Nobody wanted math. But people, including me, started coming in and trying to do some things mathematically that had been previously done by intuition or tradition. And it was astonishingly successful, even to us. We thought it was going to be successful. We had no idea how much. To give you one idea, the Salomon Brothers mortgage desk, and the mortgages were one of the first products that were mathematicized. In 1982, that one desk made more profit than the sum total of all profits of all U.S. banks since the Revolutionary War. The field of finance had grown by 1982 100 times in size, and it's grown another 100 since. And it's all because of mathematics. It's all because we can do things now mathematically that we can do them far more efficiently than they could ever be done before. But we noticed something. There was a problem. We would get these disasters. Now, in those days, in the 1980s, finance wasn't as big as it is today. It wasn't on the front page. Most people didn't notice financial disasters. And in fact, if you weren't a quantitative person, you wouldn't even call them disasters. There had always been crashes and booms in finance. But when you start looking at things quantitatively, you would do these very careful models. You would come out, and suddenly these 5 and 6 standard deviation events were happening. Things that just should not happen with anywhere near that frequency. And they were always bad. And when we studied these carefully, and this is now we're getting about the late 80s, we realized that it wasn't that people were using decision theory wrong. It wasn't that people were making bad decisions. They were doing the decision theory right, but they were still ending up in disaster. And a quantitative movement, a bottom-up quantitative movement grew that developed some tools that showed us what you can add to decision theory in order to make good decisions, and it came to be called risk management. It's an orthogonal field. You can look at a decision in decision theory terms, you can look at it in risk management terms, and the two answers don't have to be correlated at all. But we also discovered if you use the two of them together, you do much better in the long run. So let's talk quickly about sort of what decision theory is and how risk management differs. The 6 points on the left are things that Professor Borsuk, they're the key points of his lecture describing what decision theory is. So first off, we know that models are essential for predicting the outcome of complex systems. There's really no alternative to a model. And that's absolutely true. We need the models, but modeling is very hard. So we need something more. Professor Borsuk then went on to point out that policymakers are often underwhelmed by models because models, and this is true of science in general, it often gives uncertain, complex answers with lots of error attached to them. And it can seem to a policymaker as if the scientist doesn't know anything because they're saying, well, we think this is true, but there's a range of error for this and the uncertainty. And this is absolutely true. And decision theory, in a way, is an attempt to summarize that uncertainty, to make a useful decision even when there's uncertainty. But again, decision theory is not enough because there's more to uncertain decisions than just calculating the mathematical statistics. Professor Borsuk hypothesized, and I think this is probably true, that this disconnect was leading to an incoherent and ineffective international policy response to climate change. You have a clear problem. We don't have a magic solution to it, but we know some things that would help. And sometimes we don't seem to do anything. Sometimes we seem to do a lot of stuff that may or may not really make sense. We can't really seem to get countries to coordinate well. We make these nice-sounding international agreements, but they don't really seem to always translate into what you would want on the ground. And my reaction to this is, sure, if we were more technically certain, If climate change were an issue like building a bridge, we wouldn't have a problem. Policymakers decide, build the bridge, don't build the bridge. They don't get involved in the engineering calculation of how much stress the bridge should hold, what sort of stress or structures it should do, because the technical answers to those things are pretty clear-cut. Where you get a problem is when there is true technical uncertainty. If we knew exactly the environmental impact of burning 1 liter of gasoline, and we could tell you exactly over the next 50 years how that would affect human welfare, I don't think there would be much policy problem. But because there are large uncertainties about all this stuff, people can pick whatever policy position they like and kind of try to wedge it in the uncertainty. That's not always true, by the way. I mean, they may have to do a lot of violence to the science or to the mathematics to do that, but unless you have real certainty, it's hard to get people to agree. So he thinks we need new methods, and I agree, and I think we have a good method. One of the problems of decision theory is decision theory requires you to categorize the preferences and behavior. And if you're making a decision for one person, that's hard enough. If you're trying to think yourself, what do I want to do? It can be pretty hard to figure out what your true preferences are, what you're really going to do. People are always making decisions they don't stick to. They buy a gym membership and then they never go to the gym. They say they want to study tonight, but they don't. They go off and do something else. And when you talk about groups of people, what are the preferences for the world population, it gets even more complicated. One of the nice things about risk management is we bypass that step. We don't ask what anybody's beliefs or preferences are. And finally, another challenge is to accurately represent the complex knowledge. It's hard to tell people, if you know something simple, if you know some truth written in stone, you can just repeat it over and over, louder and louder, and you can communicate it to people. If you know a complex scientific truth, it's pretty hard to communicate that, especially if someone isn't that interested, is not that technically qualified. How do you tell them what you know and what you don't know, what the true uncertainty is, and what are the things that go beyond the bounds of reasonable debate? Again, it's hard to do. People are often tempted to simplify, and that can do a lot of damage sometimes, because if you simplify improperly, you can end up both giving wrong advice, leading people to wrong decisions, and you can also decrease trust in the field. So risk management kind of tries to dodge that question as well. It tries to give good advice without modeling complexity. So what are the differences? Well, I'm going to give you 7 here. The first 6 are all the good things about risk management. But there is, of course, there's no free lunch. The 7th one tells you what you have to give up to get it. So decision theory gives perfect answers, precise answers, if you have exactly the right data and you make very strong assumptions. So risk management dispenses with the needs for those things. Risk management tries for accuracy. We try not to be too wrong. We don't even try to be precise. Decision theory, you need complex joint distributions. Risk management does everything univariate. Decision theory requires a utility function. I'll talk about a bit what that is. Most of you probably know. Risk management dispenses with those. Decision theory is expensive. Professor Borsuk was describing research. He didn't tell exactly how many people were engaged in it, but it looked like a project of a dozen or more. Professors and graduate students with a large grant over many years. Risk management you can do on the back of the envelope, one person, on a train ride somewhere. Decision theory will have a different answer, potentially, for every person or group. Risk management has a universal answer. Decision theory is very difficult to tell after the fact whether you made the right decision or not. If you say there's a 40% chance it will rain tomorrow and it rains tomorrow, were you right, were you wrong? Who knows? It's hard to tell. Decision theory, risk management has a very precise way to measure whether you were right or not and help you improve. Decision theory has a very strong theoretical ground. I'm not going to go into it, but in fact there are, and you have to make some assumptions. I'm overstating it perhaps a little bit, but basically if you don't make decisions using decision theory, you can be proven to be irrational. And by irrational, I mean you could present this person with a set of decisions such that they will make they will get themselves to a deterministically worse place than they have to. In risk management, you're going to see whenever I have to do the proofs and stuff, I'm going to do a lot of hand waving and use some general things. Risk management is not something you can prove mathematically, but it does work. Let's start out with a simple choice. Professor Borsick used the Jones seminar cookies. I see times have changed, by the way. You still have the Jones seminar cookies, but you also have yogurt and fruit and healthy stuff like that. But I do notice there were cookies back there, and I do notice some people took one, some took two, some took up to 4 that I saw. There may be more in the back. So I'm going to do it with money, because I'm a finance guy, but you can use utility theory with anything. And I'm going to do it with a very simple example. And the simple example is somebody offers you a gamble, and 50% probability. If you win 20% of your net wealth. If you lose 18% of your net wealth. But we can do it with cookies as well. What decision theory says is first you have to define this thing called a utility function. And don't ask what utility is. Some people think it matters, some people think it doesn't. But for our purposes, we're not going to worry about what it is. It's just a function, and it's a function that helps you make decisions. And every outcome has to have a utility. So we have this function u, and it's of wealth, and it tells us kind of how happy we are at different levels of wealth. If we take this gamble, there's a 50-50 chance we'll get 1.2 wealth, and a 50-50 chance we'll get 0.82 wealth. If 0.5 times 1.2 wealth plus 0.5 times utility of 0.82 wealth, if that's greater than utility of wealth, just U of W, then we take the bet. And here's a specific example of a utility function someone might have. This is called a hyperbolic absolute risk aversion utility function. It's one a lot of people like to use in research. If this happens to be your utility function, you would take this bet if your wealth was more than $51 million, and you would decline the bet otherwise. Now, forgetting about the actual amount, 51 million, the answer makes sense that a very wealthy person might take this bet because it does have a positive expected value. You win if you win more than you lose if you lose, and it's 50-50. But for most people, the pain of losing 18% of their wealth would exceed the pleasure of adding 20%. Different people might have very different numbers. They might have different utility functions, so there might be a person who will take this bet if they had $5. There might be a person who wouldn't take this bet if they had all the money in the world. But in principle, this kind of makes sense that you have this utility function, and the utility function helps you make decisions. Here is the general form of the hyperbolic absolute risk aversion utility function, and it's got a parameter in it. I actually didn't give you all the parameters. There's also a parameter here that I just set at -0.1. This parameter here, gamma, measures risk aversion. So the formula I showed you before is the red line, is if you set gamma equal to 0.5. If the utility function is very straight, if it's pretty much a straight line, then you're going to evaluate gambles by their expected value, and you're going to take this bet. If the utility function is strongly concave, like it is here, you're not going to take this bet because getting halfway in between 2 points is higher than going 1 point here and 1 point here. You're better off staying on the line. With a risk aversion parameter of 0.3, this green line is very strongly curved. You will actually never take this bet. You can get infinitely wealthy. You would never take this bet if this is your risk aversion. If you have gamma 0.7, this blue line, you can see the blue line's pretty straight, and you'll take this bet at fairly low levels of wealth. With the intermediate case, the red line, you would take the bet at 50 million. Okay, so that's how risk aversion works. Here's another chart. This shows you the minimum wealth at which you would take the bet versus the risk aversion, and you see in log terms it's pretty linear. It's not at the ends, it's not linear, but basically the higher the risk aversion number, the less risk averse you are, the more willing you are to gamble. And as this number gets up toward 1, you're willing to take this gamble even for very low, even if you're not very rich at all. whereas as gamma gets toward 0.4 or so, you need very, very large amounts of money, large amounts of wealth to let you take this bet. But now I want to show you something else. I want to ask a different question. I took 20 different people and simulated them taking this bet, this 18%, 20% bet over and over. And here's what the paths look like. This nice, solid, smooth black line, that is the expected value. That is increasing your wealth 1% with every bet. And this is the expected value. But I think you'll notice none of the paths look remotely like the expected value. You may also notice that although some of the paths soar way above expected value for a while, they all go down below. If I were to continue the simulation farther, all of the paths would become indistinguishable from zero. And it's even worse than that. Let's say these were 20 hedge funds that started out. Well, these hedge funds here would all quickly go out of business. Nobody would ever hear of them. But this guy here, this one here, this one here, when they got up to here, they would attract enormous investment. Not only that, everyone would imitate them. So that when they went through their collapse, they would have far more money invested than they did on their upswing. And there's another perverse thing here. Look at all of these paths. All of these people, like to get here, look, he was here, he had this big drawdown, and zoom, he made it back up. And her, you know, she's up here, she has one here, she had this big drawdown, she made it back up. What do they learn? They learn that you always stick with things. Doesn't matter how many times you lose, how bad things get, you just keep on plugging and you always come back. Except you don't. What really happens is you always end up at zero. So who can tell me what's wrong? Why do you always end up at zero making this positive expected value bet? What is the fatal flaw in this bet? It's something invisible to decision theory, because decision theory told us this bet is a matter of opinion. Some people like it, some people don't. Risk management tells us this is a fatal, this is a toxic bet. Anyone who takes this bet is going to lose all their money. Anybody see the flaw here? All right? The expected return is indeed 1%. If you take the bet 8 times, n times, your expected return is n times 1%. But look at the median value of the return. If you win one bet and lose one bet, that is if you have average luck, you're going to have an expected return. Unfortunately, something got cut off here. I was going to actually do this calculation for you, although most of you should be able to do it in your head. You have an expected return, a median return of negative 0.8% times n. So every time you do this bet, your expected wealth increases 1%, and your median wealth goes down 0.8%. What does it mean if your mean keeps increasing and your median goes down? Your mean is increasing exponentially, your median is going on a negative exponential. What it means is, these are both absolutely true. Your expected wealth really does go up 1% every time, but it becomes a microscopic probability of astronomical wealth. In the long run, you have to win 52.1% of your bets just to break even. And that's virtually impossible for large N. If you do 1 million bets, you're not going to win 52.1% of them. And these astronomical wealths are not realistic. They very quickly become more wealth than exists in the world, in the universe. It's quickly more than every atom in the universe. And the probability is, 10 to the negative 10th probability of 10 to the 20th wealth is just a ridiculous thing, and not something you should really make decisions about. Okay, so we have two answers. We have a decision theory answer that says this bet is a matter of opinion, and we have a risk management answer that says this bet is toxic. Which one is right? Is there a person with such high risk tolerance they should take this bet, or is this bet nobody should ever take it? Well, my answer is you need both answers because they're asking different questions. The decision theory is saying, should I make this one bet now? And it's giving you the precise correct answer to that question if all of your assumptions are exactly correct. Risk management is saying, if you make bets like this enough, you're going to end up in disaster. This bet may be a good strategic decision at the moment, sorry, a good tactical decision at the moment, but as a risk strategy, it's flawed. As a risk strategy, it cannot win. The risk management view of the world, and here's where the hand waving comes in, says, look, you're going to take a lot of bets in your life. Everything you do is a gamble. Millions of gambles in your life. And therefore, you're going to come out very close to your median outcome. Nobody's really lucky or unlucky, because if you take a million coin flips, you're all going to end up at the same place. Therefore, if you look at every bet you're offered, every risky decision you're offered, and you select the option that maximizes the long-term median return, you are going to end up in the best possible place. That's going to be better than asking yourself how you feel about the bet and making decisions based on your risk preference. Now, we can go back and we can see why this has all of the advantages I told you about. We don't need much in the way of strong assumptions or data for this. We don't need to know anything about utility functions. We can do it multivariate. One of these bets can be about cookies, one can be about your health, one can be about money. Doesn't matter. We just look at each bet individually, univariate, and we ask ourselves, what is the median outcome? Very cheap and easy. We don't have to worry about a lot of complexities of decision theory. This answer is the same for everybody. Because risk management treats all bets as the same, we can measure our performance. Decision theory, every bet is unique. And from a unique bet, there's no way to tell whether you were right or wrong. But in risk management, I can go and I can say, okay, look, the last 100 decisions you made, here were the results. If you had been less aggressive, you would have been better off. Therefore, you are too aggressive in general. I can't tell you which of the decisions were right or wrong. I can tell you that you're taking too much risk. You should cut back. You should be more cautious in what you do. But there's no theory to it. This long-term, millions of bets, so only the median matters, that's not really a proof. I hope none of you think it's a proof. It's kind of a general rule of thumb that seems to work pretty well. It doesn't apply to every bet. For example, some bets are so large that you can't count on millions of bets in your life. If you bet your life, well, you don't get to do that millions of times, or you don't get to lose that more than once. So some very big bets, you have to say, I'm not going to do the risk management thing. It's also, for any particular bet, it is possible to say, okay, I understand that this bet is a bad risk strategy, but it is so tactically attractive, I'm going to take it. I look at the risk management approach very similar to the categorical imperative. Some of you may have studied in philosophy. Categorical imperative says, for any action you do, ask yourself, would I want everyone in this situation always to make this decision? And it's a great rule. It can save you from a lot of stupid decisions. A lot of things you can think, gee, this looks like an attractive thing to do, but then you think about, would I want everyone to always do this in this situation? You say, nah. Risk management is a lot like that. You run your decision theory, and your decision theory says do it. If your decision theory says don't do it, then you just throw it out. You forget it. It's not, you don't have to worry about it. But if the decision theory says do it, you say, okay, what if I did this a lot? What if I always took this attitude and made this kind of decision? Where would I end up? And if that is you will end up at zero, then it's a very, very hard decision. We really want to have a very good reason for why you want to do something that's strategically stupid because it's so tactically attractive at the moment. You can violate the risk management. The risk management argument applies to millions of decisions. So for any 1, 2, 3, 5, 10, even 100 decisions, you can violate it without too much worry because it's a very long-run argument. But if you do it too much, if you keep doing decisions that don't make sense in risk management terms, if you do it long enough, it will catch up with you. You can, you can do really, really well for a while making stupid risk management decisions if you're a little lucky, but don't do it forever. Do 1 or 2 of these if you must, but don't do 250 of them. I want to briefly, this is not directly related to the talk, but I do want to explain that one way you can fix this problem is if you're allowed to size the bet. If you can take, and this is true for a lot of risks, you can take them in larger or smaller amounts. We said before the mean return was 1%. The median return is negative 0.8%. We call the difference between those two volatility drag. This is what you lose from ups and downs. Let's say you just cut the bet by, I'm sorry, if you cut the bet by some factor, your mean return goes down by that factor. So if you multiply your bet by 0.2, you will multiply your mean return by 0.2, but you'll multiply your volatility drag by 0.2 squared. So as you make the bet smaller, the volatility drag gets smaller relative to the mean, and you get your maximum growth if volatility drag is equal to half your mean return. You can think of it as spending half your return on volatility drag gets you the best median return. And the reason I like to look at it this way, and so if you multiply your bet by 5/18, so you'd have a bet, instead of winning 20%, you would win 5.56%. Instead of losing 18%, you'd lose 5%. If you do that over and over, your median return increases at 0.14%, the 0.28 minus 0.14, and you actually will grow at that rate. So you will have an exponentially increasing, well, you won't exponentially increase at 1% per bet, you'll only exponentially increase at 0.14% per bet, but you'll actually get it. That's your median return. And one thing that's important to understand is if you think about things in volatility drag terms, there are times when you want to make decisions that would not make sense in a long-term strategy. Think of volatility drag as what you pay for being opportunistic and safe, for upside or downside, upside potential or downside protection. If you quickly, when you succeed, if you quickly follow up that success very aggressively, raising your risk, and if when you have some losses, you very quickly cut back on risk, you're going to pay a lot of volatility drag. You're going to give up a lot of your mean return. Your median return will be much less than your mean return, but you will exploit success very quickly, right? Because when you're successful, you get a run of good luck, you will really exploit it. You can survive very long downswings because you're cutting risk very quickly after losses. Another strategy is just not taking risk. You want to bet the same amount every time. You pay zero volatility drag. Your mean return and your median return are the same thing. But you can't really exploit success, right? You're just winning the same amount every time. You're not getting exponential growth. And you can ruin, right? You get a bunch of losses in a row, you run out of money because you're not cutting your bets after losses. You can even decide to do the opposite, to cut risk after wins and increase them after losses, and then you can earn volatility drag. You get paid to do that. However, you limit your upside. If you have successes, you're going to cut your risk and you'll hit a cap on success. And if you have a bunch of losses, you're going to go broke very quickly because you're increasing your risk after every loss. Anybody know what this is called? This actually has a name. We got any extreme programmers here? All right, people in business often will say, fail fast, right? Plunge, don't plan. Go in, take your best shot. If you're going to lose quickly. Get it over with and go on to the next project. What might this make sense? Well, there are a lot of projects, for example, where you have a capped upside. You're delivering a new computer system. Well, you're either going to deliver it and get it installed or you won't. Yeah, it could be a little better, a little worse, but the big decision is, are you going to get it done or not? And you've got some resources budgeted for this, and you're not really going to want to salvage the resources afterwards if the project fails. You might as well use them all up. In that sort of situation, it makes sense. If your project is ahead of schedule, doing well, you cut risk. You double check everything. You go very slowly. You do a lot of documentation and testing and so forth. If your project's behind the schedule, you start cutting out the testing and just plunging ahead and hoping to try and make it work. So the risk management answer, the risk management approach, doesn't really tell you what to do. It just tells you make a risk strategy. And there are times when fail fast is the right strategy. There are times when this is the right strategy. But most of the time, for long-term things, this makes sense. This is how you get your maximum growth. So for projects that have very large upsides, where the downside really matters, you don't just want to go to zero and lose everything if you're going to lose, this is really the right decision. Now, before we get to climate change, I want to talk about 3 experiments. And the first 2 of them are in this book. This is a great book. I highly recommend it, by a German professor who studies failure. He's an engineering professor, by the way. And he does a lot of really fascinating experiments. And these kind of dovetail with the lessons we learned in risk management. And the first experiment I want to talk about is his meat locker experiment. He created a simulated meat locker on a computer. And the problem is you are called in. You are called in. There's a meat locker. The meat has to be within a certain temperature range or it very quickly deteriorates. If it gets too hot, the meat spoils. If it freezes, it damages the meat. And the thermostat is broken. And they're getting a replacement in, but until they get the replacement in, you're the person who has to decide how high to run the refrigeration. And you got a temperature gauge that tells you what the temperature is. And you got a dial, and the dial tells you how much refrigeration you're doing. If you turn the dial to the right, clockwise, you increase the refrigeration. If you turn it to the left, kind of clockwise, you decrease the refrigeration. Unfortunately, the dial has no markings on it, and you have no idea where it's supposed to be. Now, I want to make it clear, he does this experiment with lots and lots of different kinds of people, including engineering students. He explains it very carefully. He shows them they get to play around a little bit before they actually do it. And he explains it very explicitly, there is a lag. If you turn this dial, it takes a little bit of time for the machinery to kick in. The cooling takes place, and you're not going to see an immediate response in the temperature. So then he lets people do it, and virtually everybody destroys the meat. And they do it the same way. They turn the dial. They turn the dial to the right because the meat is too hot when they get there, and the temperature is rising. Well, the temperature doesn't immediately turn around, so what do? They turn it some more, and more, and more. Finally, the temperature turns around. Great. They wait until it gets back into the proper zone, and then they start turning the refrigeration down. Well, by that time, it goes straight through and freezes everything, and they go back and forth. Has anybody ever done something like this in a shower? Okay? It's a very human thing to do. It's very, very hard to really believe there are lags, right? If the water's too cold, you turn it up. If that doesn't seem to help, you turn it up again. Can anybody tell me how you should do this experiment? What is the right thing? Yes?
Oscillate between the extremes, high to low.
Okay, called bang-bang control. I don't say that's a bad idea. You might work that way. It's exciting anyway. Incremental change, that's half of it, but there's another very important thing that you're probably thinking of but not saying. Wait. Whatever you do, wait until you see how it worked. So you turn it, and then you sit back. When it reaches an equilibrium temperature, you say, okay, I'm going to turn it again. Now I got a new equilibrium temperature. Now I've solved the problem. Right now I can use some linear interpolation to figure out where I should set it. Maybe I have to do some back and forth. Maybe it's not completely linear. So this is an easy problem in theory, but one that's very, very hard for people to solve. Now, let's think about that with respect to climate change. Well, climate change is a little tougher. Why? Well, we don't have a meat locker, we don't have just a refrigerator. We have a very complex system, right? Whatever we do, there are going to be very complex responses to it. And we're not talking about 5-minute lags. We're talking about lags of decades, possibly centuries even. We don't know. Second, we don't have a single dial to turn. We have a bewildering alternative set of policy options we could do to try and tackle the problem. And we don't have an engineering student sitting in a nice, comfortable office trying to make this decision. We have a possibly dysfunctional group of decision makers. Okay, if we can't do the meat locker, what possible chance do we have to do something rational with global warming? We do have a chance, and I'm going to tell you what it is, but I'm going to tell you another piece of bad news first. Professor Donner does another experiment with a village. Similar kind of thing. Brought into this village, and this is a village, and you're allowed to change things in the village. You can direct. It's a little bit like if anybody played SimCity or Age of Empires, things like that, one of those things. Except it's much simpler than those. You have a few things you can change. Once again, virtually everybody kills everyone in the village within 10 years. And how do they do it? Well, they try to solve every problem. For example, there's high disease rate. So people bring in vaccinations and medicines and doctors. What happens? Population goes up. They run short of food and water, so they dig more wells. They bring in more animals. Whoops, run out of water, groundwater. Crop fails because of overgrazing and things like that. And every problem that comes up, they patch it immediately, and it leads to more problems. So what is the right way to solve this problem? Not the extremes. Yeah. Okay, that's half of it, right? It's very important. Whatever changes you make, wait and see. But that was the lesson we got from the meat locker. Make whatever changes you're going to make, but wait and see what they do before you try and fix them. Yeah?
Don't try to completely solve each problem.
Yes. Come up with some desired future state. Now, you can't do it perfectly, right? We don't know exactly what's going to make the people in the village happy. We don't know exactly what the medicine is going to do. But you can guess. You can say, okay, here is my vision. My vision is 20% more population, this birth rate, this death rate, this food supply, this water supply. So you come up with this kind of future state that's sustainable. You don't just try and solve one thing and then see what happens and then try and solve the next problem. Within the sustainable solution, you don't try to go to it right away. Say, let's make a step toward it. Again, like the meat locker, we want to say, okay, we want this step to be big enough that we notice the effect. If we make it too small, we won't be able to tell what we did. But we don't want to make it so big that not only the areas kick in and we end up with some state that we send out, ends up sending everybody killed. So we make a moderate-sized step in the direction we want, and we wait and see what happens. And we learn two things. We learn the effect of our interventions, and we learn how we like what happens, right? Often they're unexpected things. We say, gee, we thought this was the desired state, but it wasn't. We went to where we thought we wanted to be, but we didn't really get there. Okay, and finally the third paper is a different kind of paper. This is by a guy named Victor Hagani. Some of you may know him. He was one of the founders of Long-Term Capital Management, a hedge fund that blew up very spectacularly in 1998 and was actually added a lot to our knowledge of risk management. And he took some quantitative finance students and young quantitative finance professionals, and he offered to let them play a game. It's a real money game. He gave them $25, and they were allowed to flip coins with a 60% chance of success. And they could bet however much they wanted on these coin flips. It was real money, and he told them there's a cap on how much you can win, but I'm not going to tell you what it is. If you get to the cap, or if you make a bet that would put you over the cap, then I'll tell you what the cap is. And you had half an hour to play. And you could, click pretty fast. You could get about 300 flips in there. If you do any reasonable strategy on this, you will almost always get to the cap, which was $250. 95% of people should get to the $250 cap, unless they do really perverse, stupid strategies. And on average, they should make about $240. In fact, fewer than 20% of people made it up to $250. More than that, almost double that number, actually went broke, lost everything, and the average payout was $71. So the average person made less than a third of what they should have lost. And he talked to them afterwards, and basically all of them had been educated in the math you need to figure out the right betting solution. Not necessarily the exact optimal betting solution for this, but at least a reasonable betting solution for this. Nobody used it. Nobody really believed what they were taught. Now these are in finance, quantitative finance students who spend an awful lot of time being taught exactly this sort of thing. And I want you to think about, to me this is really important. This was not such a large amount of money that they were blinded by fear or greed or nerves. It wasn't, okay, you can kind of understand why somebody who's suddenly thrust into $1 billion decision might get carried away. But it also wasn't so trivial that you would expect them to blow it off. $250, is enough that you probably pay a little attention. And yet, they didn't believe it. They didn't use it. And this, to me, is a tremendous indictment of quantitative financial education. We don't really teach people to believe how you do things like this. I do have a paper up here that I wrote, by the way. I have a few copies if anybody's interested, that goes into a little more detail on this. But here's the problem. If even quantitative professionals who are trained specifically to make this kind of decision don't believe how to apply it in the simplest situation. By the way, 60% coin flips, that's about as simple a decision as you can get. How can we possibly expect that they're going to be making reasonable decisions when the problems are far more complex, the stakes are a lot higher? All right, now let's finally get around to talking about global warming. Well, the first thing we want to do is we want to think about a future scenario. We don't want to jump in and say we want a carbon tax, we want cap and trade, we want fuel emission restrictions or mileage minimums or something like that. We want to think, what future state are we trying to get to? And one of the problems is I've talked to a lot of people interested in this issue, and people have very, very different ideas of what future state we want to be. And I've kind of put them in 4 groups here. Now, people have subtleties of difference. I'm maybe a little bit of a caricature here, but I'm kind of in this group here. I think technology is going to save us. I think we can have an increased human population. I think we can all live in great material comfort, culturally rich lives with negligible environmental footprint, because I think we can get the technology to save us. I don't know that. I don't know how to build the technology. It's a faith. It's a leap of faith. But this is where I want to get. I want to figure out ways where we can have the Earth and have everything else. Have a large population, have all the material wealth we want. I want everything. So that changes how I think about a lot of stuff. Another big group thinks the only real solution is a much smaller population. That humans have an inherent environmental footprint, at least humans living the kind of lives we want people to be able to live, just take a certain toll on the planet. And you can't have 7.5 billion people living materially abundant, culturally rich lives without trashing the planet. So ultimately, we gotta get down to a few million people or something, or maybe a few tens of millions or hundreds of millions, but less than that. Now, most of these people, some of these people are really pretty scary, but most of these people don't expect this to happen quickly. Most of them are not killing themselves to get there. People realize it will take centuries to do this in any sort of humane way, so you need a lot of intermediate steps. You gotta reduce environmental impact of the current population, but the long-term solution for these people is fewer people. Then there's the people who think, no, we can have all the people we want, they can be really rich, happy lives as long as they renounce materialism. As long as they realize you don't need SUVs, you don't need plasma TVs, you can just, dance in the meadow and have a great time. So for these people, the ultimate solution is reducing the consumption per person of material goods, changing to a richer cultural life and make people happy that way. And finally, this is a big group, and you may make fun of them, but I think there are actually probably a lot of people here who kind of agree with it, and it's, let's just see what happens. Right, if it gets hot, we'll buy swimsuits and sunglasses. If there's sea level rises, well, great, the beach is closer. We'll just go ahead, do what we want. If we like it, great. If we don't like it, we'll fix it then. And this is a particularly dangerous idea because of the lags. If we didn't have lags, if we immediately got the environmental consequences for whatever we did, this might not be too stupid a thing to do. In fact, for a lot of things, the right approach is to do nothing. If the thing gets worse, then fix it. If the thing doesn't get worse, then it went away and you shouldn't have to bother about it anyway. The trouble is, let's say hypothetically we get to this point very briefly in 2030, And then in 2035, these people are all underwater and boiling or whatever. You know, and it's too late to stop it. Nevertheless, this is a very powerful group, and you have to take that into account. Whatever decisions you make have to make sense. If this is truly the best solution, and by the way, this is a solution humans have used every other time in history. Problems like this have arisen, and you know, we're still here, right? People said coal would run out. Well, we found oil. People said water power would run out. Well, we found coal, you know? And people are pretty rich and happy, some people anyway. So this is something we have to think. So whatever solution we think of, we have to think about how is that solution going to look to each of these 4 people? Can we sell it to all 4 groups? If we can't sell it to all 4 groups, it's going to have to be imposed. And imposed solutions have all kinds of disadvantages. Another thing I want to do before we actually get to the decision is to talk about a mistake I think a lot of quantitative people make. And this goes all the way back to Adam Smith, who you may recall wrote the first really modern economics text. And Adam Smith mentions something called the invisible hand once. And Adam Smith spends nearly 100 pages talking about a pin factory. Well, the invisible hand, if you notice, if you actually read the quote about the invisible hand, it doesn't mean what people think it means. It doesn't mean there is this invisible hand that always leads us to perfection or anything good. It just says it might do it. The pin factory is an example of positive feedback. Adam Smith said that the more specialization, the cheaper pins get, the more people buy pins, the more specialization you can have. As production goes up, technology improves, specialization reduces costs, and you have a positive feedback. Invisible hand is a negative feedback. It says, well, if the price of something goes up, then demand will fall, supply will increase, and we'll get back into equilibrium. The invisible hand is not very important in the world. Negative feedback is not what drives important change. Positive feedback does. It is technological change. It is huge mass movements. These are the things that matter. Now, the reason that a lot of quantitative people gravitate toward this invisible hand, why they remember that from Adam Smith and forgot about the pin factory, is that it makes nice calculus, optimizations. It's a kind of equations people like to solve. Whereas positive feedback is unstable. It's very difficult to find solutions. So what people are apt to do is they're apt to put the global warming, climate change thing, they're willing to say, well, the constraint is the damage to the economy. So we want to put in the regulations that balance economic damage, how much we reduce GDP growth versus how much we harm the environment. We see this as a positive feedback. But that's not really the right way to think about this. The world is full of positive feedback. Fire is positive feedback, right? Fire releases heat, heat ignites more fuel, increases. But the whole world hasn't burned. Why? Because positive feedback eventually runs into negative feedback. So what happens, though, if you want to really think about how the world works, everything important in the world, we get these positive feedback things that grow, they hit some constraint, they stop. It's not a careful equilibrium of everything carefully balancing. That's just not how important things in the world work. What are the real issue I think we have from a decision theory standpoint is we have, at one extreme we can do what the happy beach people want to do. At one extreme we can say, we'll let the market sort it out, right? Oil will decline in availability, the price will go up, things will naturally plan and work and sort everything out for us. The other extreme is to say, let's just impose a solution. Let's drastically cut back on all kinds of emissions of every sort. Now, the problem with the market solution is that while it has a lot of advantages, it's very subtle. There are millions of people out there making very detailed, specific plans, far more subtle and accurate than we could ever make top-down. We know it's very difficult for a top-down command economy to even deliver bread to people. You know, the last thing it can do is really figure out all environmental consequences of everything. So if we get too dramatic, if we interfere too much with market mechanisms, we could just go off into some unstable space. We have no idea what it's like. We could go down an entirely different technological path. It might solve the problems we're trying to solve and bring up a whole bunch of new problems. It might reverse and do the opposite of what we want. On the other hand, the environment's also unstable, or we don't know that it's stable, let's put it that way. We don't know that we can keep adding carbon to the atmosphere and have, you know, some linear effect. There may be some point where the effect is nonlinear. There may be all kinds of processes going on. And it's not just carbon. Everything humans do has the potential for, you know, when you multiply anything by 7.5 billion, it can have a dramatic impact. Some of those impacts will have negative feedback. Some of those impacts will get damped down and not cause great damage. Some will have positive feedback. We don't really know which is which. And I don't mean to undersell climate science. There are people who think they know something about which are which, but at this level I'm talking about, it doesn't matter. Some things will have positive feedback. Some things will turn out, even a little change turned out to be disastrous. So what we want to do is we want to figure out some fix that doesn't do so much damage to the economy that it sends the whole economy on some wildly unpredictable path, but also minimizes environmental impact so that we think at least the next 5 years won't be terminal for the planet. So let's kind of review what we want to do. We want a simple change. We want it big enough so we can measure the effect. We want to avoid catastrophe. We don't want to make it too big. We need to keep it in place long enough for equilibrium. That's very important, right? We can't just do a policy today and 6 months later do another policy. And we want to make sure that it is a step forward for everybody. Everybody sees this as a step forward. It may not be a big step, but it can't be a negligible step. Now here's kind of where risk managers, you know, I can tell you, I've been in a lot of meetings as a risk manager, and people are talking about all these different things. Everybody else in the room you can think of as a decision theorist. And they're talking about all the details, all the things they want to measure, all the calculations and so on that they've done. And the risk manager is not playing solitaire on their phone or something. And somebody says, well, what do you think? Say, well, I don't really care how much you turn the dial on the meat locker. You guys figure that out. All the same to me, I want it big enough so we can measure the difference. I don't want it so big that it risks you know, destroying the whole equipment. But the big thing is once you put it there, leave it there for 5 minutes and don't touch it. And they think you're crazy, right? I think I'm the Zen master radiating a deeper knowledge of truth. They think I'm just some crazy nut. But it is important to do that. Now, let me give you a few round figures here. I deliberately condensed everything to try and simplify a lot, and I've done a lot of violence to the complexities to do it. But here's how much energy we're using now. And I call it oil equivalent because I said, well, what if we got all of our energy from oil? Well, we don't, but we do get about 87% of it from things that are, you know, fossil fuel-like, and about 40% is that from oil. So if we think of every thing in terms of oil, it's a lot easier. Here's our carbon dioxide emissions, and we know this number is too high. We may not know exactly how much too high it is, but it's too high. This is about how much money we spend, about the global population. And I want you to think about this per person. And we also want to think about the price elasticity. How much can you raise the price of oil, or how much do you have to raise the price of oil in order to reduce demand a certain amount? So double the price of oil, and you'll have approximately this much effect on demand. Now these are average numbers. We don't really know this, right? We haven't never doubled the price of oil so we can measure this thing. But think of these as round numbers and say, if you just knew these round numbers, what would you want to do? This is what risk managers do. We say, let's forget about all the complexity. Let's not worry about what coal versus oil versus natural gas. Let's not worry about, you know, exactly what these numbers are. Let's just think ballpark, this is what we're trying to do. What can we do? Well, changed since you made the presentation. But not that long ago, we were twice that level. So we know the world didn't end when oil got to $120. I want to set a new price of oil, and I want to leave it there for 5 years. I want everybody to know, not this is some temporary thing we're putting in and we might change it next year. I want everybody to really make their plans based on a number. I think 5 years is about right. If we said 1 year, people are going to just wait for it over, they'll buy forward, they'll do all kinds of things. If we said 20 years, then people would really change their plans, that's true, but if the number is the wrong number, we'll waiting too long to fix it. So anything under 120, I don't think works, because it might get up there anyway. On the other hand, you know, you could say, well, let's raise it to $200, $300, $500 a barrel. I think it's just, you know, we have no idea what the shock would be, and it's just too risky. So personally, I would say a figure like $150 a barrel. It's significantly higher than it's been in the past. It's probably much higher than it will ever get by natural market forces in the next 5 years. So it's big enough to make a difference, but it's not something that seems like it's going to completely crater the world economy or send us on a completely different path. Now, if we go back to this and you do a little bit of math, you'll see that should cut demand for oil by about, we go up 2.5 times. We should cut demand for oil about 20% immediately, and that means cutting emissions about 20%. And in the longer run, it should get up to about 40%. Now, a big problem, though, is how you do it. If you raise the price at the pump, you raise the price where the energy consumer, electricity, gas at the pump, and something like that, then you just get the problem that all the energy-intensive stuff moves out of the United States. Even if you try to implement something like this worldwide, you have a problem. You have to start measuring the energy input of all sorts of goods. You get something very complicated. And a big problem with this is, if you raise the price of some oil, you reduce that demand, that makes oil cheaper, that encourages everybody outside the system to use it. So unless the system is 100%, unless you've covered every bit of oil in the world, every bit of energy in the world, or fossil fuel anyway, you may end up doing no good at all. You can reduce energy consumption by a huge amount one place, makes the oil cheaper, so it just goes up somewhere else. And it's even worse than that. Even if you reduce total oil consumption, that means there's more oil in the ground. And that oil in the ground, the thing is, it's not enough to slow down the rate at which people are using the fossil fuels. You have to convince them to actually leave it in the ground forever. Right? It doesn't really matter if they burn it this year or 5 years from now. You want them never to burn it. So just raising the price for 5 years doesn't really do any good. Now, what some people believe and hope is that, well, let's raise it now, let's lower consumption now, and then hope that the world gets smarter in the next 5 years. Well, okay, maybe. I don't, that doesn't strike me as really great. What you really need here is you need a different kind of payment mechanism. You need a way to extract the money when the oil comes out of the ground and distribute it completely away. For example, if the Saudi Arabian government passed a big tax on oil, it would be paying it to itself. It would make no change in behavior, right? You need to take that money and distribute it. And the obvious way to distribute it is to distribute it per capita. If you could do that, if you could set up a payment mechanism, and I'm not going to go into details here, you probably need an entirely new payment mechanism, a cryptocurrency or something to do this that enabled micropayments throughout the world. But this is the kind of simple solution a risk manager likes. The world agrees to a high price for oil. The oil producers, you get OPEC to agree by promising them a fixed revenue higher than they expect to get at the current price. You raise the price high enough to something like $150 a barrel. You're going to generate about $1,500 a year per person in the globe. If you distribute that per capita, you eliminate extreme poverty in the world. And we know that, so we made the energy producer happy. We made poor people in the world happy. What does that do? Well, for me, I'm saying, look, at $150 a barrel, invention's going to really increase. People are going to really get hard on the problem of figuring out how we can get along without burning all that fossil fuel. I think this is going to solve our problem, and the $150 barrel, that's what works for me. These people, well, the $150 barrel is going to make things more expensive. People are going to have to learn to live with fewer material goods. And some people think they'll be happier, they'll love it, we'll solve the problem that way. This guy, well, we know fewer material goods, getting rid of poverty, we know that's the best way to end overpopulation, that as economic prospects improve, birth rates drop. So this person thinks, okay, we're going to turn the corner. At least instead of world population increasing, we can get world population decreasing. That's a big step for this person. And finally, these people, well, we're making one simple change. We're making a simple change, and yeah, they have to pay more for gas at the pump, but they have this satisfaction of knowing that we've at least made a big dent in global poverty, and we're just going to see what happens. The result of what happens is going to tell us a lot, both about how controls work. We'll really learn what happens when you triple the price of oil, what happens to oil consumption, what happens, how does the economy restructure, what technologies do we get, how does that affect carbon concentration in the atmosphere, how does that affect the climate. You know, we got a nice clean experiment there, right? For a climate scientist, it's really nice to have a clean, clear dividing line where you can see the effect of something. And most important of all, we're going to learn what we like, right? 5 years, people can say, okay, you know, this is working, or this is working, this is working, this is working. I think this is the kind of thing, I'm not making a policy recommendation here, but this is the kind of thing that could work. It might not. Perhaps it could never get done. Perhaps it could never get international support. Perhaps it wouldn't work even if it got international support. The point is, from a risk management standpoint, forgetting all the technical details of exactly how much you charge for this or that, or exactly what the rules are, this is the kind of decision where the median outcome is good. The median outcome increases. If you make this kind of decision time after time, 5 year, 5 year, 5 year, 5 year, we say, you know, the numbers say you get to a good place. It may not be, it may be the wrong number now. Maybe we found out we did too much or too little in 5 years, but it could work. We know that randomly patching every problem as it comes up and changing policies every 6 months and having all kinds of international agreements and having people, you know, go back on them. One big issue is people really make a lot of promises when times are good, and all that does is when times get bad, they go back and all that extra oil is there and it's cheap, and you end up burning more than you would have burned in the first place. And as I said at the beginning, more generally, this talk is not really about global warming. This talk is about how technical people can think of policy decisions. It's very important you don't just do the decision theory analysis, present it to a policymaker with all the uncertainties, or with overpromised certainties, where you tell them, I know exactly what's going to happen because you think that's the only way you can get traction for your ideas. It's very important you apply these quantitative tools and come up with things that are simple, that are in place long enough where you know whether they worked or not, and that are on a path to some sustainable, it can be very vague. We don't know very much about the future, but you got to be able to say this is part of a sustainable long-term plan. This is not just an immediate patch for the problem that bothers me at the moment. So I thank you for your attention, and I think do we have some time for questions? I understand some people are going to have to leave. I won't be insulted, but if you want to stay and ask questions, I'm happy to answer them.